Hi there, Dan Ferris here, editor of Extreme Value, published by Stansberry Research, and you can find more about that at stansberryresearch.com. Extreme Value is a value investing newsletter. Today we're going to talk about the dry bulk shipping industry, where I think there's a good opportunity to be a really good value investor and buy something that could be liquidated for twice its value in the stock market. And we'll talk about what the dry bulk shipping industry is and the three variables that we use to kind of gauge the history and the general health of it. And then we'll talk about specific reasons that we've recommended to dry bulk shipping companies in the March 2018 issue of Extreme Value. And no, I'm not going to give you the names of them. That's for paid Extreme Value subscribers, but I'll tell you a lot, as much as I can. So let's start with what the heck we mean when we say dry bulk shipping. So dry bulk ships, there are around 11,500 of them in the world, and they are used to ship dry, not liquid, bulk commodities. So bulk as opposed to, for example, container ships, where things aren't shipped in bulk, they're shipped in tight little containers, right? You can have all kinds of different stuff. Well, a dry bulk ship ships one commodity and you just dump it in, like sugar or iron ore or coal or something like that. And the ships range in size from the ability to ship 50,000 tons of stuff, maybe on the small end, to like 400,000 tons on the high end. And the 400,000 tons, they're specialty ships. They're made for shipping iron ore only from Brazil to China. In fact, they're made by one company called Vale, the Brazilian iron ore miner. So they're called Valemax ships. And max is something that's a suffix on the end of ship types, except for Capesize. There's Valemax, Capesize, Supramax, Panamax. All these things are just, the definition of these is just a certain size, certain number of tons, of stuff that you can fit in them. And they're called, Panamax is called Panamax because it's the biggest ship that can go through the Panama Canal. And Capesize is called Capesize because it's so big it can't go through the canals and has to go down around the capes under Africa and South America, you see. So that's the kind of ships that you have in dry bulk. Now, to get the health of the industry and sort of the recent history and where we are right now, there's three variables: the Baltic Dry Index, the scrapping activity, and the order book. So let's talk about the Baltic Dry Index, the BDI. The BDI is a weighted average of 20 daily shipping rates from 20 well-traveled global routes around the world. And it's, just the daily charter rate net of things like, canal and port fees and fuel costs and things like that. It's just what you pay. It's it's an average of what you pay per day to rent these ships and ship your stuff in these ships. And the BDI is really, this is a volatile, commodity-oriented, highly capital-intensive industry. So the prices for things are pure market determined. Nobody has pricing power, and it fluctuates all over the place. The BDI was like below 1,000 in 2001 or so, and it peaked at 11,700 in 2008. That's how it is. Just 7 years later, and if you saw a chart of it, the thing didn't just slope up gradually. It's very volatile, just ratcheting up and down. And once it ratcheted up to 11,700, it wasn't very long at all. I think that was May of 2008. And of course, we know what happened in September of 2008. The world was, the financial world was on the brink of exploding. Lehman Brothers went bankrupt, and the thing just dropped well below 1,000 at that point. I think it was below 1,000 at that point. I mean, if you just look at the chart, it's just insane the way the thing goes up and down. Since then, you've had this one of the guys at Stansbury calls it guillotine and sandpaper. So the rates fell off a cliff in 2008, and then they kind of, there was a dead cat bounce maybe a year later up to about 4,000. And then, you know, it's just that sandpaper action, and finally bottomed out in early 2016 below 300 from 11,700. So just, you know, the industry was just obliterated. Then we look at the scrapping rates. So, you know, when the BDI is up around 11,000, every rust bucket in the world is going to be in the water earning money. And the scrapping age was about 30 years. Now, dry bulk ships last, generally speaking, 25 to 30 years at a maximum. So when the average scrapping age is 30 years, man, that means there's some ships older than 30 years still in the water earning money. Of course, when the rates fall apart, that all changes. And by about 2014 or maybe 2016, the average scrapping age was down around 22 or 23 years. And that, again, these are averages, so there's even younger ships at that point being scrapped. But likely not many, I would guess. Because you can't earn, when the scrapping rates have bottomed out and are down 90% or something, you can't earn money. So people just say, well, if the thing is going to be, you know, if I'm going to scrap it in 5 years anyway, I may as well scrap it now because it's not earning a penny. We're losing money every time we take it out. And the the scrapping activity has fallen off lately because there was a regulation, there are new regulations about ballast water treatment equipment that are, all the ships are going to be required to have new ballast water treatment equipment, and that costs money. So the deadline for this was September 2017. Now it's pushed back to September 2019. So ships that may have been scrapped last year, they're still earning money, and they have a couple years of useful life left in them. And the BDI had bounced off that below 300 level, and now, you know, it's gone as high as 1,700. It's around maybe 1,100 today. So they've got another 2 years to earn some money before they probably get scrapped around by September 2019. Because if you're going to scrap it in a few years anyway, you don't want to spend $1 million on ballast water treatment equipment. So we expect more scrapping, other things being equal, starting around 2019. Third thing is the order book. How many ships are on order to be newly built at any given time? And so when the BDI was 11,000, the order book was 50% of the global fleet. Imagine that. In 2 or 3 years, the global fleet growing 50%. The all-time low was in April 2002 at 7.2% of the global fleet. It recently bottomed out again, just within the past few months, at 7.7%. It's around 8%, so around 900. I checked recently, and it was 929 ships in the order book versus a global fleet of 11,497 ships, about 8%. So the fleet, there's not a lot of growth in the fleet. There's not going to be a lot of new ships coming into existence. And starting in maybe a year and a half or so, there will be some going out of existence because the scrapping activity will pick back up. So that's where we are. The shipping rates have come up a little bit. Scrapping activity has slowed, probably pick up in the next year and a half. And the order book is at scraping all-time lows. And if you look at rates for specific ships, for the specific ships that we have recommended, you know, their EBITDA per vessel might be, just call it the general neighborhood of $500,000 of EBITDA per vessel per year. Where at the peak, back in 2008, you know, those same ships might have earned something like well, let's just call the average around, you know, 6 million, just say. So, you know, 500,000 versus 6 million at the top. You know, if you get 20% of the way back to the top, you're doing great, right? But these ships are making money. They're making positive cash flow now. And what's really neat is that the companies we recommended have less debt than other companies. And the market value, if you take the market cap per vessel, it's half of what you could sell the vessel for today. There's a fairly liquid market for these dry bulk ships. It's like selling, Class A real estate. You pick up the phone, say, hey, you want to buy this building, you want to buy this ship, whatever, and do a deal and close in a few months. Same thing for dry bulk ships. You call Clarkson's, the big broker, and before you know it, you got 5 or 10 bids, and you take a 10% non-refundable deposit, and you got a deal, and then you close the deal within a couple months. So the companies we recommended could liquidate their maybe 40-50% of their fleet and pay off all their debts, whereas their competitors could liquidate their entire fleets and still have hundreds of millions or even over $1 billion in debt in some cases. So they could liquidate the fleet right now for double what the market value of the shares is, per vessel. And they are effectively, because of the liquid nature of the asset and the market values that are predominating today, they could effectively have zero debt if they wanted to. If they wanted to shrink their fleet and have zero debt, they could do it. So we feel like we have a really good margin of safety there. Anytime you have an asset that in the stock market you're paying half of what it's worth right now in the real world, that's a really good thing. That's a classic Graham-and-Dodd value proposition. And the assets are earning money. They're making positive cash flow. And if the shipping rates go up back to any kind of a decent level, instead of $500,000 EBITDA per vessel, maybe $1 million or $2 million or $3 million, I think these stocks are going to be multi-bagger returns. I don't think it would be unusual at all for that to occur, in fact. And they're already pretty multi-bagger off the bottom, when it appeared that they were going to go bankrupt. But I think there's more. I think there's a 3, 4, 5X, 6X kind of opportunity here at current prices. And so that's the situation. And it's pretty neat. And yesterday I did a video where I called it the Amazon $6 moment, because when Amazon was $6 in 2001, of course it was set to go to almost $1,600 recently, but before that, in 1999, it had been over $100. So you had to weather this brutal, 90+% drawdown, same as in the dry bulk ships, to get to an opportunity to make many, many, many times your money. And that's where the dry bulk ships are today. And I just wanted to tell everyone about that. And, by all means, look, I'd love to have new subscribers, but I'm trying not to be desperate about it, because I don't like to give refunds. We want serious value investors only. And, if you don't want to spend, $1,000 or $1,500 on a newsletter to get opportunities like this, that's fine with me. Believe me. If you have any doubts at all, I don't want people who are going to cancel, because they think, oh, I've paid too much because I paid $1,500. But I do want folks to know about it, and I do want to talk about it. And so that's today's video. Take a look at dry bulk shipping. I think if you look around, I think you're going to find at least 2 companies that I know of that represent a really excellent, once every decade or two kind of deep value, extreme value, I would call it, proposition for investors. And to me, it's a lot more attractive to do that today than it is to pay 15 times or 14 or 15 times revenue for Facebook, or 30 or 40 times all the profit they've ever earned in their whole life for Amazon or something like that. So I hope you enjoyed learning about this opportunity, and I will talk to you as soon as I have another idea for you. Thanks. Bye.